Hi everybody, I'm Diane Brady. I am here with Victor Khosla, who is the founder of Strategic Value Partners, which I've known as SVP Global. You're also the Chief Investment Officer.
I am.
I think of you as the man who does a lot of distressed debt. Is that going to set us off on the wrong foot if I say that?
You know, Diane, I always bridle at that description.
Okay. Let's come up with what is the essence and the mission of what you do. Because it's good times for distressed debt, but we'll put that aside.
You know, we are, as a firm, we are opportunistic credit investors.
18 billion, how much do you have now?
18 billion.
Yeah.
We started out, our roots are in distressed debt and restructurings 22 years ago.
Yeah.
But when you look at the firm, the evolution of who we are today, we are, as a firm, we control 15 businesses with almost 100,000 employees. So these are all good-sized businesses.
Yeah.
We have bought some through debt. Some of them we've just bought outright. Businesses and industries we knew well. We have made large investments in airplanes. Every 2-3 years out of 10. More recently, we've been investing in planes.
Yeah.
We own one of the largest power plants, electricity producers in the US, and infrastructure toll roads. We own a toll road today outside Texas, outside Austin, and we own another one in Portugal. And so I think when you think of us as a firm, the distressed debt word, unless it costs us as somebody opportunistic, paper investor, paper trader. And when you look at us today, owning businesses, trying to improve them, owning assets, trying to fix them, you know, that's why that moniker distressed debt, I bridle at.
Well, I want to unpack this a little bit because first of all, there's a role for that, and to be excellent at it, especially in this market, is a good thing. But let's also pivot to where the firm is today. How do you want to be known when you think about, because you are somebody who looks at the investment climate, you see opportunities, that's how you grow. So let's reframe it then as to what?
A global opportunistic credit investor.
So you are a global opportunistic credit investor.
Yeah.
Sir, Mr. Global Opportunistic Credit Investor.
You're being nice.
Where are the opportunities right now?
Yeah.
We'll put distressed debt aside.
The field of play, it's just starting to emerge.
Okay.
Today. Right. So when you look at us as a firm, good investing year, we'll invest $6 to $8 billion a year.
Yeah.
In 2022, as the Fed started to hike rates, we had a Ukraine war. Last 9 months of 22, we invested a little bit more than $1 billion. We pulled back. You know, as we saw the values, as we saw the economy grind down, and we saw values grind down. Our pipeline was modest 15 months ago. There were roughly 40 deals we were looking at hard. Today, 100 deals, pipeline has tripled.
Thank you, Fed.
Thank you, Fed. Thank you, Ukraine war.
Yeah.
Thank you, pullback from China. Thank you, weak banking system. All those things, right? It's all the Fed rules, don't get me wrong.
Yeah.
The other things, it's just kind of creating this environment. And for us, our pipeline has tripled in terms of where we are and our pace of investing. Diane, I don't want anyone to walk away from here thinking, oh boy, it's really great right now. Mm-hmm. It's happening. We've invested about $1.1 billion in the last 4 months. Still a modest pace for us, but picking up from where we are.
Well, I want to talk about the Fed. You know, the gift that keeps on giving to some people and less so to others, of course, because that's also induced this banking crisis, which has been a big discussion here. I should have mentioned we're at the Milken Institute, Global Conference. Less people think we just hang out in crowded lobbies to converse. But what do you think about the actions that have been taken? Because your job is to look around the corner and look at the signals that you're seeing out of Washington. Let's take what's happened with these regional banks. Are we done now? Can we now move on?
Yeah.
And it's been contained, or what are you seeing?
When the regional banking crises, I know all of us would like to believe it's contained. The symptoms which gave rise to First Republic and Silicon Valley Bank, where people have these assets, long-term, low-rate assets, which they can mark at fair value instead of truly marking to market. There are hundreds of banks with those kind of assets. In addition to all that, it's so far been a liquidity issue, a marking issue. Now comes office. Commercial mortgages for a regional bank are 42-43% of their loan book. A substantial piece are office.
Yeah.
Now you've got credit. Credit is going to come into play with these balance sheets. So I think to our view, I hear what everybody's saying, right? I hope they are right, but the risks attendant in kind of these banking balance sheets. And Diane, it's not just here. Even while we've
This
had
is a global phenomenon, basically.
Credit Suisse.
Yeah.
Credit Suisse essentially went bankrupt over a weekend. A $600 billion bank, right? So this is not, it's not like it's contained. So I think the banking genie, the issues with it, it's nothing like 2008. Don't get the wrong idea.
What's interesting, what I like about the way you write, you think it's a little bit of a student of human behavior as well. The human behavior that spurred the 2008 crisis. You could say it was maybe recklessness. What is it that we're seeing here? It seems almost as if the gullibility of the depositors or the people that felt there would be low rates forever. I mean, what are we tapping into? Because we're going to have some corrective to this to avoid this happening again for some different crisis. How do you see it playing out in terms of the opportunities it creates for you, but what we'll learn from this?
I am a student of human behavior, but much more a student of cycles.
Okay.
Right? So can I try
Please.
and put, So since 2000, in this century, 5 bad credit cycles. This is the 6th one, right? All the cycles, they're all a little different. There was a tech crash, there was GFC, there was oil and gas. They're all a little different, but they do rhyme. This one, the one we're in today, doesn't really rhyme with any of the past 5 ones. It's got, the Fed was your friend in every one of those. To ease the economic pain, they would reduce rates. Not this time. To tackle inflation, they can't. So we think this cycle, the one we're in, right? Because it's good to have that historical cycle, right?
I think so, especially if the 6 is not like the other 5. That's useful information to know.
By the way, the other 5, they came down, like you had these peak credit spreads, they came down really fast. In COVID, they started to come down after 1 month, right?
Yeah.
This is different. So this is, if we were looking for an analogy, you've got to go to 2002, where there was a lot of things conflicting with the tech crash.
Yeah.
You've really got to go to that.
That was a slower moving tech crash than because people always thought it was a down, but it was months and months of slow carnage.
But when you look at credit markets, you'll see 3 really grindy, tough years. Nothing like after 2008, my God, we started to recover pretty ruddy fast, right?
Yeah.
Just don't think it's happening here. And I think, and by the way, human nature, none of us is so foresighted that we've got this wonderful world which we think is stable and steady.
Yeah.
And it's going to be like that forever, right? None of us is. So again, like this time around, you asked the question about, hey, did depositors miss it? There's always somebody missing something, right? So I wouldn't be. I actually think the banking issues today, in the overall scheme of things, though, still modest.
Modest.
Worry about the Fed.
Worry about the Fed.
Yeah.
Okay, so I'm going to sleep at night. I'm thinking about the Fed. What should worry me about the Fed?
When are they going to start to take rates down? So
I thought there's supposed to be one more hike and then that's it. So you're now saying, when are they going to start to go down? So
yeah,
enough already, go backward.
So if you're a student of emerging markets, the emerging market investors will tell you that the central bank of Brazil or wherever has to take short-term rates higher than inflation to lick inflation. Well, guess what? The Fed's now got rates at 5%-ish. Inflation is about 5%-ish. They've done it. Now, they want to get rates
and
down.
China still doesn't want to buy. No, I'm just kidding.
The rates, they want inflation down to 2%. They're going to, I think, one man's view, we believe the Fed will have to keep rates up higher for longer, because today we are expecting sort of these cuts starting late this year, early next year. I think they could perhaps be delayed. And worry about the ECB, the other big central bank. They're 9-12 months behind the Fed.
They seem to have less latitude, given the situation in Europe, given the, many voices that enter the head of, the ECB leader. They wouldn't have as much, do they have as much agency, might be the right term?
Less than the Fed. But they are generally, our view, they're generally always a little bit more dovish. But this inflation we have is so corrosive.
Yeah.
If you have 3.5%, 4% long-term inflation, that's corrosive, right? And to lick it, the ECB now is in the act of kind of doing the Fed trick also. And worry about Europe, because you've got an economy on the face of it, if you take it all together, about similar size. And you've got kind of a policy response which is delayed. And you've got a lot of friction. The way you said it, I'd say you've got these tectonic plates in Europe which keep grazing against each other. Worry about Europe.
The earthquakes.
Because it'll come home to us in the US too.
Well, it's interesting, the earthquakes. I want to end by putting a mirror up back again to you. In terms of the way, if I'm seeing it correctly, you're seeing this as the beginning of a period of investment for you where you're seeing a lot of opportunity. I won't go back to the opportunistic, but so what excites you when you look at this market? If you were to say and it could be in the policy context, but also in the global context, what's on your radar you would put on ours? Knowing that we'll be after you, so you'll be there first. So
we are, to us, this world we are entering, what we find is the first year and a half, there's a lot of interesting classic paper investing. Mm-hmm. Because when these cycles start, what happens is people have outflows. They're not even distressed companies, they're distressed sellers.
Right.
So there is a period of 12, 18, 24 months where the liquid event-driven side gets to be interesting, and we are sort of in that stage.
Okay.
What excites
We're at the interesting stage in that, month 18?
Yeah. So now, month 8, month 9, the really good businesses which have a levered capital structure but need to do something, and they can plan for it, they start to appear. The businesses where we can take control of businesses and fix them and improve them, there's more of them which starts to appear. And I think to us, Diana, this is not my first rodeo, right?
Right.
So what we find is, for us, it's patiently working through those many pieces, those many different sub-cycles which go into it. And I think, and that's our view today, we are doing all that, and we are 40% of our business is in Europe, and we are really ratcheting up resources
into
Europe, because I've got a funny feeling it's going to be bigger than 40 in this cycle.
Really?
Yeah.
So the Ukraine, are we over-indexing on the Ukraine, kind of like just writing off Europe as like, well, let's just wait till that's over?
Yeah.
That's interesting. Okay,
Yeah.
good. I look forward to continuing this conversation. So thank you so much for joining us. Anything else you'd like to throw out as a nugget to our audience to think about?
This was fun. Talking to you was fun. Enjoyed it. Thanks
Good.
for having me.
Thank you so much. I appreciate it.